Chain Dost. I hope all is well. The situation is not really good in India. So stay home, stay safe, go outside whenever it is necessary, use precautions, social distancing if you are going outside. So that's the only way which we can save ourselves. So we have to utilize this time, don't have to waste the time by sitting at home. So today's our topic will be IAS-21, change in foreign exchange rate. So what is change in foreign exchange rate basically? We have to understand this topic. It's in if it see in terms of international accounting standards IAS-21, and in India it's India's 21. The name is same, change in foreign exchange rate. What is change in foreign exchange rate? Suppose you are dealing with currency which is other than INR. So on the closing date or on subsequent recognition, we have to put that currency in the terms of INR because we live in India. In India, it's INR currency. So we have to decide. First of all, we have to decide when we have to book this currency, the subsequent recognition and that initial recognition and subsequent recognition. Secondly, we have to decide in which currency we have to prepare our financial statements. So I prepared some notes. I will share the screen. From there, we will start with how to do this. Now the screen is shared. It's foreign exchange, change in foreign exchange rate. What basically it is, we have to see. The first we have what we learn in this classes. What is this accounting issues? What are the functional and presentation currencies? What are the individual entities and how we will disclose this? Now, starting from accounting issue, I know the notes is a bit because I've taken the guidance from somewhere and I highlighted those points. So that's why I copied that note only for you, and it will be a better understanding for you. What is the accounting issues related to this? See that I told you earlier, company may engage in foreign currencies operation in two ways. First is directly into transaction denominated in foreign currency and by conducting foreign operations. Like I'm sitting in India, I'm doing the export to Singapore in USD currency. That is, I'm directly transacting, doing the transaction in USD. Secondly, my office is in India and my another office is in Singapore. I'm doing the business from that Singapore business. That is a foreign entity. That entity can be subsidiary, joint venture, associate. It depends. What are the main issues involved in it? First is the which exchange it should be used for translation of the transaction. Secondly, how to treat any exchange difference that arises. That like if we at the date of transaction, the rate was 74. At the end of 30 March, the rate comes to 70. So that 4 rupees difference, where we have to go. Either we have to take in profit and loss, or it's other comprehensive item. So we will decide that also. Now first we will clear some terms used in this uh, international accounting standard. You can say India's, they are one and the same thing. There is no major change in that. But there we have to first learn the three terms: functional currency, presentation currency, and foreign currency. What are these? See, functional currency basically currency of primary economic environment in which the entity operates. What does it mean? It means in which we are doing the major source of business, major how in which economic environment, like I'm living in India, in which currency I'm dealing. So deciding whether the function, which is a functional currency, there's different parameters that we will learn in a few minutes. So we have to decide because functional currency, we have to decide on three parameters that we will come back to it. The second is presentation currency, the currency in which the financial statement is presented. Basically, the presentation currency is the functional currency. That and what is the functional currency? We have to decide on the different parameters. Third is foreign currency, uh, in which books are prepared, it's known as presentation currency. And maximum presentation currency is functional currency. Other than that currency is foreign currency. Now, uh, the closing date is a spot exchange date at the date of the financial position, like 31st March in India, the close of financial year. And what is the next is what is monetary item? Items which we have to which we have to convert and exchange it to so that we can book it in profit and the exchange gain or loss we can book in a profit and loss or the OCI item. What is that? Money held and asset and liabilities to be received or paid in fixed or determinable number of units of currency. Money held, as money which we are having either in the form of assets or liability, which is to be received or which is to be paid. And that amount should be fixed and determined in number of units of currency, either in INR or USD. For example, monetary items are trade receivables, cash, trade payables, loans, and non-monetary items are non-current assets, investment, and inventories can be any. Now, deciding what is functional currency. That we discussed earlier also that it is a primary economic environment in which entity operate is the functional currency. So, what is the primary criteria for deciding what is a functional currency? The primary criteria is the currency that mainly influences the selling price of goods and services. It is that currency in which we book our turnover. Like in India, if we are doing the sales and we are booking our turnover in INR, then our functional currency will be INR. Suppose I'm living in Singapore, I'm having a entity in Singapore, I'm invoicing in USD. Our functional currency will be USD. Second criteria, in the primary criteria, the second point, the currency that affects the labor, material, and other cost of providing goods and services, direct expenses. So, if we satisfy both the conditions and both the conditions satisfy that there is one currency like either it INR or both are USD, then that will be the functional currency. But the major question is, suppose I'm doing the export and I'm in it's an Indian entity. I'm doing export. Export are done in USD, and our direct expenses are in INR. What should we do now? What will be a functional currency? Then we'll move to the secondary factor. What is the second factor? The currency in which funds from financing activity are generated. Like we are getting a finance from the bank, we are getting finance from other sources, operations. So, which currency are we using? And the currency in which monies from operating activities are kept. Like it means profit. I have highlighted profit. If primary factor there is a contradiction in both the points, then we'll come to secondary. Secondary says from financing activity and from operating activity. Like in India, we both are having INR, then we will function currency in INR. Now the main issue is, I will give an example. Entity is listed in Singapore. Singapore currency is Singapore dollar. So I'm doing the export invoice are generally use the currency USD, but direct expenses are in SGD. So it's a bit it's also not satisfied primary condition. Then we will come to secondary from financing activity. If in Singapore I get the finance from the bank, if it gets in the USD, then and our operating profit net profit is also in USD, then the functional currency is will be USD. But if we are getting a finance from Singapore dollars in Singapore SCD, then our operating activity will be also profit will be SGD, then our functional currency will be SGD. But what majorly uses, if like in this current example only, our invoicing is done in USD, and our direct cost is in USD. So in Singapore, we use the functional currency USD, not SGD. If secondary condition doesn't satisfy, then we convert to the other factors. What are these? Basically, 95% cases satisfied in up to both the conditions. Whether activities are carried out as an extension of reporting entity, whether transaction between the reporting entity and phone operation are a higher percentage transaction. But you can read it out from this slide. You can take a screenshot also for a future reference. Now, if functional currency is not obvious, management must use their judgment in identifying the currency that must faithfully represent the economic event. I will share with you that one format in which the management decides which currency they are using. Once a functional currency has been identified, it should be changed if there is a change to the economic climate. It's normal. If the economic environment changes, then we have to change the functional currency, and management has to decide it again. I told you earlier also the functional currency will usually also be the presentation currency. Both will be same in the maximum chances of it. If there is an entity want to choose another currency, then can choose. Then management has to disclose why they're using another currency rather than the functional currency. Now, coming to the initial recognition. Foreign currency transaction will be recorded at the spot exchange rate. Means the rate at the date of transaction. We have to book at that rate. And exchange difference arising on settlement of foreign currency transaction in the same reporting period are recognized as profit and loss. Like my financial is April to March, I purchased in the month of May, I paid in the month of January. The exchange rate difference will be in the profit and loss, not anywhere. Subsequent recognition means at the end of balance sheet date, like 31st March. What is that? At the end of each reporting period, any foreign currency monetary item is retranslated using the closing exchange rate. Discussed earlier also what is monetary items. For example, trade receivable, trade payable, like asset and liabilities, which is received or to be paid in future. Amount is fixed and the currency is fixed. Those are monetary items. Exchange difference on translation of a foreign currency balance are recognized as a profit and loss for the period. Non-monetary item which are historical cost and translated at exchange rate at the rate of transaction. No need to book that again. So what we have done, that the exchange rate difference will move to profit and loss. Now, non-monetary item measured at fair value that different IAS is applicable. This is one example. This is nothing else. Now, we will overview what we have done. Transaction during the year, actual rate at the date of transaction took place, historic rate, or average rate, whichever is there. This is the when the settlement is done during the year. Now, balance at the end of the reporting period. There are two criteria: monetary item, non-monetary item. Monetary item we have to retranslate at the date of statement of financial position using the closing rate, and non-monetary item we don't have to translate. So doesn't arise the question that we have exchange foreign exchange difference. The difference which arises in monetary items all are recognized in profit and loss, and that settlement during the period that will also will book in profit and loss. Now the next is disclosure. The amount of exchange difference included in profit and loss for the period. During the period which is the exchange difference, we have to uh, book in our disclose in our notes. Like there is some extract. Net exchange difference classified in equity is a separate component of equity, and a reconciliation of the amount of such exchange difference at the beginning and the end of the period, and the change in foreign currency and the reason for the change. So what we have learned, basically we have to understand our three terms: functional currency, presentation currency, and foreign currency. For functional currency, we have to decide, the management will decide what is the functional currency. Uh, like I will share you one thing, uh, which the format which management has to decide what is the functional currency. It's up to the management. If we can understand, if we can bifurcate these things, then we can easily uh, prepare our financials in terms of that currency. So here it is ready. I will share the screen. Here it is. Management assessment of functional currency. Primary indicator. This is one of my clients. That's why ignore this portion. The main influence arises sale or purchase. It means turnover, direct expenses. Sorry. This is the first only the turnover. This is the direct expenses. Both conditions satisfied in one currency, then we will use the same currency. If it doesn't satisfy, then we will come to the next, the other indicators, and we have to decide, and we will come to the conclusion. So here it is. I hope you like our video. If you have any queries, any question, can comment uh, and subscribe our channel for future classes, for future understanding, for future discussion. Thank you so much, Jay.